Remember, all of these things, artificial intelligence and everything else, can never replace the image of God implanted on the human heart. We cannot create a technology greater than we are. God is the one who is the creator of all things, and there's no way that I can create something better than God can create. Welcome to Life in the Markets. My name is Tim Russell. Today is Monday, February 16th, and I'm so glad to be able to talk to you about last week, which was a little bit of a rougher week in the market. Obviously, it was choppy, but at the end of the day, the S&P 500 was down over 1.17%. If we look at the NASDAQ, the tech-oriented NASDAQ, it was down 1%. If we look at the Russell 2000, smaller companies, the Russell was down 1.28% or 1.25%. So we're seeing across the board, all of the major indices were lower. There are just a few things that perhaps would be of interest to note at this point before going on to some of the other things we normally talk about. On a year-to-date basis, the S&P 500 is now down about 0.9%. The equal weighted S&P 500, remember, we talk about the S&P 500 as it stands is based on how big the company is, and that's how much of its allocation it gets in the S&P 500 index. Now, the equal weighted index, when we forget about the size and we just give everyone the same weighting in the index, that one on a year-to-date basis is not down. It's actually still positive 5.5%. Now, even the equal weight S&P 500 was down this week, but it's good to know, it's interesting perhaps to note that while the cap-weighted S&P is down 0.9, the equal-weighted S&P is actually up 5%. That is the largest disparity we've seen in a very long time between the cap-weighted and the equal-weighted S&P 500. The NASDAQ is down 3% for the year-to-date. The Russell 2000, again, smaller companies, we talked about that being down a little bit more than some of the other indexes this week on a year-to-date basis, is still positive 6.5%. So still seeing positive, healthy movements within our smaller size companies. Getting back to commodities on a weekly basis, we saw gold was down a little bit more than 0.5%, 0.6, 0.7%. Silver was down 7%. Silver is still really struggling to kind of get its legs under it. So down 7.7. Oil was down about 2%. These things, honestly, I think are good to see a little bit of a healthy movement in gold and silver as a bit of a corrective, making sure we're looking at real levels. Oil coming down is going to help with gas prices in particular and other fuel-related expenses. We also tend to track Bitcoin, and we've been documenting the implosion of Bitcoin over the last few months, and this week we saw Bitcoin drop another 3%, which on a year-to-date basis, Bitcoin is now down 21%. On a year-to-date basis, oil is actually still up about 9%. Silver is up only 6%. It was up a whole lot more earlier this year. Gold is up 16%. So overall, it's very interesting how this year is shaping up for our commodities. Bonds had a positive week. We see that bond yields were able to actually drop a little bit. So bond prices went up. Bonds were up about a little less than 1%. High yield bonds were roughly flat. The 10-year Treasury, I said the yields actually went down, but the 10-year Treasury, this is interesting. The 10-year Treasury did have some movement this week. It declined a little bit. It was 4.23. Now it's 4.05 this week. So a little bit of a positive movement on the U.S. Treasury market. Now, this past week, we had an inflation read come out. And when inflation numbers come out, it's always interesting to see what's driving inflation. The headline number was not significantly worse. We saw prices increase by 0.2%. Not a huge number. So the actual inflation rate went from 2.2 to 2.4, according to the CPI, the Consumer Price Index. What's driving inflation? Actually, interestingly, food is driving inflation a little bit more, and it's food outside the home. We're talking about restaurants and things like that. That was up actually 4.7%. Energy was an interesting one. Energy was flat. Remember, we've been talking about oil, generally speaking, up for the year, down for the week. But as we look at the energy section within the inflation report, we see energy largely flat, and we dig in a little deeper and we find that the oil costs have actually declined this year, but the power generation cost has seen a marked uptick. Specifically, we're seeing it's about a 7.2% increase for utilities and things like that. So this is something that I'm going to speak to in just a moment, but it's definitely interesting to see how power is becoming more of a driver of inflation at this present point. All of that to say, now I've been beating the drum, and tariffs are bad. We don't like tariffs. We wish they went away. And I also now point out tariffs are not presently driving inflation. 2.4% is not terrible. Frankly, I expected a whole lot worse, and probably the inflation picture is what it is today because tariffs have not been implemented at the scale or the extent that Donald Trump initially indicated that he was going to push it. Because of the pushback, because of the negotiations, I think it has helped us to dodge a little bit of a bullet with regard to tariffs. We're not out of the woods yet, though. We still have more work to do with tariffs to see if and when it actually does start to cause greater costs or greater problems with inflation. So stay tuned. We're going to keep an eye on that. One thing that I do think is interesting to note is that the Tax Foundation, this is a right-leaning think tank organization, they did the numbers and they say for last year, tariffs cost the average American household $1,300 total for the year 2025, and they predict that for the entirety of 2026, that the cost on the American household might be about $1,500. That might sound like it's getting worse. I would actually argue it's getting better because remember for 2025, that wasn't a full year's worth of tariffs. That was, well, let's just call it a little bit more than half a year worth of tariffs, whereas we'll have an entire year in 2026 and it's only higher by $200. I would argue on an average monthly basis, the impact of tariffs is lessening, and I think we can be encouraged by that. I have a link in our show notes to the Tax Foundation article that kind of goes into the Trump tariffs and the trade war. If you find it interesting, take a look at that. Now, what I want to spend the rest of our time talking about today is artificial intelligence. And there are some very interesting things with regard to artificial intelligence and potentially challenges that it's going to face that says maybe we as investors should pause our exuberance about artificial intelligence until some of these things start to work themselves out. Now, in the past, we've talked about the crazy level of spending that hyperscalers have been putting out for artificial intelligence. What is a hyperscaler? I'm sorry. Thank you for asking. A hyperscaler is a company like Amazon, Alphabet, Microsoft, Meta, Facebook. These companies are spending hundreds of billions of dollars. In fact, it is predicted that this year alone, in 2026, these organizations will spend upwards of $650 to $700 billion, with a B, billion dollars, just on artificial intelligence. Now, the problem, as we have pointed out, is that all of these investments presume that these products are actually going to be able to create some amount of profit relative to the investment going into it. And while I do believe that long term, that's probably going to be the case, I think we have a tough road to hoe before we start seeing some of those profits or even some of the revenue to start coming back in a cash positive way to help actually justify these expenses. So I do think that these companies, while having enormous cash flow and actually being generally healthy financially companies, they're investing at such a high level that it's probably not going to all pay out for all of them. For some of them, it'll be a tremendous investment. For others, it may not work out so well. So that's one problem. It's been well documented. We've talked about it here on the show. There's another one I want to bring to you today, and that is the AI power gap. The AI power gap references the real hunger that AI chips and these data centers have for electricity and power just to generate all the algorithms, all the number crunching, all of the wonderful things that AI does. We have an incredibly inefficient system or inefficient technology when it comes to the utilization of energy. So studies have been done. There's a real problem that we have data farms coming, and data farms are going to need a lot of energy. It's estimated that by 2029, or actually 2028, there's going to need to be new energy capacity of 44 gigawatts of power. That's a huge amount of power. And at the current rate, we only have about 25 gigawatts scheduled to come online to supply the 44 gigawatts and the rest of the power grid that we need. So at some point, something's going to have to give. Either we're not going to be able to bring as many data centers online, which is going to have significant negative impacts on the the hyperscalers and the investment that they're putting into these data centers, or it means that we're going to need to create new energy in some form or fashion. So what I'd like to do is look at maybe some of the ways that this problem will be solved. I'm not a doom and gloomer here. I think that this energy problem is a fantastic problem for us to be facing, and it's a fantastic problem for us to solve. And there are potentially really good ways that we can solve this energy gap and create ongoing energy self-sufficiency here for the United States and help to upgrade and improve our power grid. So the first and perhaps the thing I think is the most probable solution is that every single one of the chip manufacturers is working on creating ways of making more energy efficient chips. These are the very powerful chips that are used in this AI computations. They demand a lot of power, but right now they've been working over the last, let's say, 40 years. They've been working something called Moore's Law, which says that every so many years, the speed and the power of the chips doubles and the size reduces in half. And that's been roughly accurate. Now we're getting down to the level where the chips are literally so small. We're getting to the atomic level here, where there's only so much smaller they could physically go. Physics is an obstacle to actually getting these chips to operate or to work in a way that I think we want them to work. The challenge here is that when you can only get so much smaller, you've got to find efficiencies in other ways. And all of these chip manufacturers are well aware that they have to solve the energy problem. So therefore, they're all working on, rather than reducing the size, let's reduce the energy demand. Let's find ways of making it even more efficient. We might start finding ourselves entering in a new kind of Moore's Law framework where instead of reducing size, we're reducing energy demand. That could be enormously beneficial to our entire ecosystem, to our entire energy infrastructure, if we can get more power with more output, technically, more computational output with less power demand. That could be a game changer for America. The second thing that I think is a likely scenario here is that we're going to see a reduction in the regulations preventing power capacity to come online. We have way too much regulatory hoops to jump through just to be able to bring on that power generation. I was doing some research, and it says that it takes on average 5 years from idea to execution to actually create a power plant and bring it online and go through all the regulatory process. And that's assuming everything runs smoothly. When you run into even more issues with the not in my backyard folks or other individuals citing environmental issues or concerns, that process slows down markedly. The third recommendation that I have that I think could be a very powerful solution to this, notice a pun on the word power, is to use SMRs, small modular reactors. These are nuclear power plants. They're small modular nuclear power plants. These are already in operation in things like nuclear subs or in our aircraft carriers. These are the nuclear power systems that generate the energy needed to run these vessels effectively, fastly, cheaply. And I really think that there's something to this. If we were to unlock the safe, clean power through nuclear energy done on a modular level, these things can be rolled out in conjunction with AI data centers, adding net energy to the actual grid, creating even more potential independence. I really think that we as a nation are going to have to wrestle with what do we actually think and believe about nuclear power, and when should we actually start adding more nuclear capacity to our power grid. I do think that that is absolutely one of the options that needs to be on the table. At the end of the day, AI is facing headwinds. They are dealing with bubble-ish kind of activity and pricing, but AI is a powerful technology that's not going anywhere. It's here to stay. As a fellow believer, right? I think you and I need to, rather than be, thinking that our AI overlords are about to enslave us and, bring in the Terminator-like scenario, I really think we need to be much more engaged with the artificial intelligence landscape to find ways of ethically and morally using the technology for the advancement of the gospel and the glory of God. Remember, all of these things, artificial intelligence and everything else, can never replace the image of God implanted on the human heart. There is never going to be a technology that a creation makes. You and me, we were created. We cannot create a technology greater than we are. It's just not possible because we believe in God, and God is the one who is the creator of all things. And there's no way that I can create something better than God can create. So don't get all worked up about AI. AI is okay. AI is not the end of the world. AI is definitely going to have problems. It's going to create some societal issues. But as a fellow Christian, we should engage with the technology. We should help shape the technology to the glory of God and the flourishing of society. All right, in conclusion, I wanted to share our verse of the week, and we're going to look to Philippians chapter 4, verse 8, and it says this: "Finally, brothers, whatever is true, whatever is honorable, whatever is just, whatever is pure, whatever is lovely, whatever is commendable, if there is any excellence, if there is anything worthy of praise, think on these things." So as we wrap today, it's very easy to get all excited or worried or anxious about AI. Let's focus on what is true. Let's focus on the fact that we serve a great big God who is mighty and powerful and working out his plan in this world. Let's trust him and let's keep our eyes on him rather than the uncertainties and the fears that surround us in the world. Until next week, take care, God bless, and be safe in the markets.
Topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.